Welcome and thank you for joining me for Tax Break. This is a podcast about South African tax for South African tax professionals and practitioners. My name is Pieter van der Swan, and in each episode I discuss a topic or a recent development in South African tax. And I try to keep the episode short enough that whenever you need a bit of a coffee break, you can make that coffee break your tax break. Right, our topic for today, we're continuing from the same topic as the previous episode, and if you listen to that, you'll recall that I spoke about what a listener asked for, tips and tricks of the objection process. Now, as I said last week, the process, it's a rule-driven process and it's governed by legislation, so there's no real tips and tricks involved. And we focused on a few elements of the process. So we looked at, for example, requesting reasons to understand why the objection, on what grounds you should be objecting, and when your objection could potentially be invalid or what could invalidate your objection. So this week we're looking at and focusing specifically on the grounds of objection. And I guess that if you're looking at, if we want to talk about tips and tricks, there's perhaps more of an art to drafting these grounds than there is to just following the rules of the process correctly. So if we look at some important principles relating to your grounds of objection, you'll recall from the Dr. X case that I spoke about last week that these grounds cannot be vague and not specific. If they are vague and not specific, you run the risk of the objection not being valid. So let's have a look at what the legislation or the rules, the dispute resolution rules, tell us about these grounds. So these rules require that your objection must include the grounds of objection. And then it goes on to say that these grounds that you've got must include three very specific things. It must firstly specify the part or the specific amount of the assessment that is being objected to. It must specify the grounds of the assessment that you are disputing. And lastly, it must include the documents required to substantiate the grounds of objection that if the taxpayer hasn't previously delivered these documents to SARS. So looking at what are the grounds of objection really? So if we're looking at this rule 7.2b that I just described, what are you really required to do here? And I think in simple terms is the grounds of objection is where you put your case forward. So that's the merit of your case or the case that you're making. And it would normally be a combination of clarifying the facts and circumstances that you're relying on and then applying the legislation to those facts and circumstances. And it can become quite complex. It's often very technical. So this is where you find that you need to know the law quite well, that you need to really look at the case quite critically to see what is the case that you should be putting forward. Now, a question that often comes up in this regard is, what if you've missed something in these grounds? What happens then? So there were two High Court cases last year dealing with this specific question. There was the baseline civil contractors case and then the TALT case, or I'm not sure if you would pronounce it the TALT case. Now, in the baseline contractors case, the taxpayer was a partner in a partnership and it received a profit share from the partnership. It claimed a deduction which SARS then disallowed, and the taxpayer objected against the disallowance of the deduction. And later on in the process, when it came to appeal, the taxpayer also included an argument to say that besides, they still contended that the deduction should be allowed, but they also added another cause to their argument to say that we also believe that this amount never accrued to us. It should never have been included in our gross income. So that's the baseline case, and we'll get back to it just now. The TALT case, and I can maybe from the onset mention to you, I don't think that case is the the textbook example of how to object. If you read it, you'll see that the taxpayer is a trust. It was assessed by SARS for capital gains tax. And initially, the taxpayer objected against the understatement penalties. Then they lodged a second objection. Now, I'm not sure that that's the textbook process of dealing with objections, to lodge a second objection. I'm not even convinced it's something that's really catered for in the dispute resolution rules. But in any event, the second objection was submitted, and that it dealt with prescription of the tax itself. And at the appeal stage, these two objections were combined, and the taxpayer at that point added an argument that dealt with the merits of the capital gains tax that SARS imposed. Now, in both cases, SARS argued that there's new grounds being added, and you can't do that at the appeal stage. And the answer to, or whether courts looked for the answer to what you can add later on and what you can't, we find in two provisions, both relating to the appeal process. Firstly, Rule 10.3 that deals with the grounds of appeal. What that rule says, a taxpayer may appeal on a new ground not raised in the notice of objection under Rule 7 unless it constitutes a new objection, and this is now the critical part, against a part or amount of the disputed assessment not objected to under Rule 7. So you can add a new ground, but it cannot be a new objection against a part or amount of the assessment that you didn't previously object to. We find a similar rule in Rule 32.3 that now deals with the taxpayer's Rule 32 statement. And it says that the appellant may include in the statement a new ground of appeal unless it constitutes a ground of objection against a part or amount of the disputed assessment not objected to under Rule 7. So it's basically fairly in line with what Rule 10.3 said, just at the later stage of the process. Right, so in the baseline and the contractors and the TALT cases, the court then had to go and consider based on the facts of the two different cases, did the taxpayer in adding the new ground, did they add the ground against a part or amount that was not objected to, or did they satisfy these requirements to be able to add the new ground? If we start on the baseline case, what the court said there, although the amounts were numerically the same, so the deduction that was not allowed and the amount that the taxpayer later argued should never have been included in income, the fact that the amounts are numerically the same, and if either is allowed, it would give you the same net outcome. That's not sufficient to say that it's a part or amount that you've previously objected to. So if you look at your tax return and your tax computation, one element of that is to say you've got your gross income that you're starting with, your inclusions in income. Later on, there's deductions. So what the court held in the baseline case is that those are different parts or different amounts, and the taxpayer was not allowed to add the ground. In the TALT case, where the taxpayer then, if you recall, on the second objection, objected on the basis of prescription of the whole tax amount, the court did find that whether you've objected to the CGT being imposed on the basis of prescription or on the merit of the CGT being imposed, that is the same amount that you've objected to, and you could then add grounds of appeal. And what's quite interesting about the TLT case is that the court focused quite strongly and based their view on the fact that if you followed a different interpretation, that would allow SARS to extract taxes that are not due to it. Right, so if we stand back a bit then, what if you missed a ground of objection? So if what you've missed is objecting to a part or amount in the assessment, then and you've not objected to that at all, then you may have a real problem. If it is that you've objected to the part, but you subsequently realize, but there's another argument that you should have put forward, or there's a different argument, that is probably something you can then add as you get to the appeal stage. As you can also see from the baseline contractors case and the TLT case, it is quite fact specific, and it could be that you find some resistance along the way from SARS. I guess the other thing, and that's a more practical question than something that comes from the rules, is that with all these disputes, taxpayers often find the need to balance costs in preparing these grounds of objection with the risk of closing a door going into the future process. So what I believe is that if you've got well thought through and well formulated grounds of objection, you do give yourself a much better chance at the objection stage, which could then save you a lot of costs and effort of going into the appeal stage where the matter could have been resolved at the objection stage. And that could perhaps in future become even more true if we've got an alternative dispute resolution process at objection. Right, so to conclude, what are the grounds? It's really the merit of the case and the argument that you're putting forward. If you did not object to an amount or part, then you are prohibiting from adding grounds to that part or amount in the future. But if you did object, you can still change course to some extent. That's it for today. If you've got any questions or comments on the episode, please send me an email. My email address is in the show notes. If you've liked the episode, please like it on YouTube, subscribe on your favorite podcast platform. And as always, remember that the podcast is not advice or a substitute for fact-specific advice. Until next time, goodbye.